Hi there, this is David Weiss. I'm a senior analyst at Aite Group. We're a global Tier 1 research and advisory firm in financial services. I want to talk to you a little about one of our latest reports, the Swap Execution Facilities Review for the fourth quarter of 2016 and 2016 Annual Update. Now, this report is one in a series of ongoing reports we put out periodically covering the OTC derivative space, initially from the U.S. point of view, but as we get more and more data, eventually from a global OTC derivatives perspective. As anybody who looks at this space, covers it, trades in it knows, for the last 3 years, U.S. SEFs have kind of been meandering around in this liquidity desert, where as much as 50% of the liquidity that used to pass through the U.S. globally stops here, because people don't want to be caught up in our trading mandate, because the U.S. is on the bleeding edge of OTC derivatives reform. But something remarkable happened in the last quarter of 2016, and it seems to have been driven by a trifecta of Brexit reality, surprising 2016 U.S. election results, and finally rising U.S. interest rates. And we believe it makes it quite plausible to have 20% growth in 2017 in overall SEF volume, which would be quite remarkable. Now, notwithstanding those externalities, it's also possible that global OTC derivatives will finally reconfigure back to a more global presence. We don't think there'll be a reconstruction back to the former true global unregulated market space, but in addition to the U.S. mandate, we also have a trading mandate in Japan for IRS, and hopefully, finally, at the beginning of 2018, we'll see the mandate kick in Europe for OTC derivatives to trade on organized trading facilities, their SEF equivalents, OTFs. Even if that doesn't happen, though, it's fair to say for the next 4 years, the U.S. is going to have its fair share of increased domestic volatility, and that trifecta is also going to drive a fair amount of global trade friction. And that in itself is likely to drive up OTC derivatives trading, IRS as usual, and particularly FX OTC derivatives trading. Now, we still have 17 active SEFs, same as last quarter, but we have 19 total now, 2 new ones. One new one is Hotspot, which is basically BATS acquiring and resurrecting the old Javelin SEF startup, and it still has its existing IRS registration, but presumably they're going to be trading FX to mate with their Hotspot FX ECN. And BATS itself, of course, is being acquired by the CBOE to create another global exchange group. The second new SEF is called the Next SEF. When Michael Spencer sold ICAP to Tullett Prebon, he kept a lot of the non-broking business, the electronic post-trade platforms, and the EBS FX market, and formed a new company called Next. Next doesn't have a SEF, so they're going to create a new one, initially trading in FX, and presumably they'll try and leverage the synergies off of EBS and the other post-trade OTC derivatives workflow platforms to generate some business there. It'll be interesting to see what kind of success they have. Taking a look at the SEF volumes over the last 3 years, we can see that it's quite fluid. It ebbs and flows amongst the larger participants, although ICAP and Tullett Prebon have always had a big chunk of that. When it comes to what constitutes SEF product volume, it's mostly IRS. But interestingly, we see very nice FX growth despite there not being any kind of trading mandate. All that FX business is organic. It's mostly non-deliverable forwards. Now, taking a look at operators, we can see when you look at all the SEFs each of them operate, Tullett Prebon and ICAP have a huge chunk of business. The other IDBs, BGC and Tradition, are still there and competitive. And we, of course, see Bloomberg and TradeWeb, which had a 33% growth in 2016. They're very competitive. And Truex is still hanging in, growing slowly but steady. But when we take a look at that liquidity post-Tullett Prebon ICAP, the TP ICAP entity, we can see that they have 60% market share, something that didn't trouble any of the regulators, although I don't think that market participants are going to be as accepting of that. Capital markets doesn't like monopolies. So it's going to be interesting to see how well TP ICAP can maintain that kind of market share. And if they don't, who's going to make up the difference? Will it be Tradition? What's going to happen to Tradition, actually? They're kind of like the last IDB standing. So we cover CEFs overall, taking a look at the performance over the last quarter or year, and giving a projection for upcoming volumes. And we do the same thing for each of the IRS, CDX, and FX products. We also cover M&A that happens in the space and individual developments, performance, new products, and whatnot. Now, Aite Group has a deep research library, which includes previous reports on OTC derivatives, as well as global macro market structure, of which OTC derivatives is one component. We have more reports coming out, not just another report on CEFs and OTC derivatives in the near future, but also fixed income platforms, which is related to this. Go to our website, itegroup.com, and take a look at our research, upcoming reports, and the other services we provide. Whether you're an existing customer or interested in becoming a new subscriber, reach out to us and let us know what you think. Once again, this report is Swap Execution Facilities Review for the fourth quarter of 2016 and 2016 Annual Update.